The real reason big investors are moving out of tech stocks right now has nothing to do with panic and everything to do with strategy. If you've been watching the market lately, you may have noticed something unusual. Tech stocks that dominated headlines for years are no longer the only focus of Wall Street. Some of the biggest institutional investors in America, hedge funds, pension funds, and large asset managers are quietly trimming their positions. But here's the important part. They're not running away from technology. They're repositioning for what comes next. For more than a decade, U.S. tech giants like Apple, Microsoft, Amazon, and NVIDIA have led the market. These companies reshaped industries, drove innovation, and delivered extraordinary returns for investors. From smartphones to cloud computing to artificial intelligence, tech became the backbone of modern economic growth. If you simply held major tech stocks over the last 10 years, chances are you outperformed most other sectors. But markets don't move in straight lines forever. They move in cycles. The first major reason big investors are pulling back is valuation pressure. After years of strong gains, many tech stocks began trading at extremely high price-to-earnings ratios. Even great companies can become expensive when their stock prices rise faster than their actual earnings growth. Institutional investors pay close attention to valuation metrics because future returns often shrink when stocks become overpriced. When expectations are already sky high, even small disappointments can trigger sharp corrections. So instead of waiting for that risk to materialize, large funds begin trimming exposure gradually. It's not emotional selling, it's disciplined risk management. The second reason is interest rates. When the Federal Reserve raises rates, borrowing becomes more expensive and future earnings are discounted more heavily. High-growth tech companies are particularly sensitive to this because much of their value is based on projected future profits. When rates rise, those future profits become less valuable in today's dollars. That shift alone can justify a rotation out of growth stocks and into sectors that perform better in higher rate environments, such as financials or energy. Big investors constantly adjust portfolios based on macroeconomic conditions, and rate cycles are one of the most powerful forces in the market. The third factor is sector rotation. Every economic cycle has leaders and laggards. During early recovery phases, growth stocks often outperform. But as the cycle matures, investors start looking for value and income. Recently, we've seen capital flowing toward energy companies, industrial firms, and dividend-paying sectors. This doesn't mean tech is collapsing. It simply means money is diversifying into areas that may benefit more from current economic conditions. Professional investors understand that leadership changes over time, and positioning early can make a significant difference in performance. Another critical reason is concentration risk. Over time, a small group of mega-cap tech companies began dominating major indexes like the S&P 500 and NASDAQ. At one point, just a handful of companies accounted for a large percentage of total index gains. When portfolios become too concentrated in a few names, risk increases. If one company misses earnings or faces regulatory pressure, it can drag down entire indexes. Institutions prefer balanced exposure, so even if they remain bullish long-term, they reduce positions simply to avoid overconcentration. There's also the issue of profit-taking. Many institutional investors have held tech positions for years and are sitting on massive unrealized gains. Locking in profits after a long bull run is a rational decision. Portfolio managers are evaluated on performance and risk control. By selling a portion of winning positions, they secure returns and create capital to deploy elsewhere. This is a normal and healthy part of market cycles, not a sign of collapse. Artificial intelligence hype has also played a major role. Companies tied to AI saw explosive price surges as investors rushed to gain exposure to what many believe is the next technological revolution. While AI absolutely has transformative potential, markets often move faster than fundamentals. When excitement drives prices too far ahead of actual earnings growth, large investors step back. They wait for valuations to become more reasonable before increasing exposure again. Smart money rarely chases hype at peak levels. Economic uncertainty is another piece of the puzzle. Concerns about slowing consumer spending, geopolitical tensions, and tighter credit conditions all influence institutional behavior. Tech companies that rely on advertising revenue or discretionary consumer purchases can be vulnerable during economic slowdowns. In contrast, sectors like healthcare, utilities, or consumer staples may offer more stability. During uncertain times, preserving capital becomes just as important as generating returns. But here's what many retail investors misunderstand. Moving out of tech does not mean abandoning innovation. The long-term themes driving technology, artificial intelligence, cybersecurity, automation, digital payments, and cloud infrastructure, remain incredibly strong. Big investors still believe in these trends. What they're adjusting is timing and allocation. They're managing exposure based on where we are in the economic cycle. History shows us that market leadership rotates. After the dot-com bubble burst in the early 2000s, technology underperformed for years while commodities and energy surged. After the 2008 financial crisis, financial stocks struggled while tech led the recovery for more than a decade. Each period rewards different sectors. Recognizing those shifts early can create major advantages. For everyday American investors, the key takeaway isn't to panic sell tech holdings. Instead, it's to understand why capital flows change. Diversification matters. Valuation matters. Economic cycles matter. Blindly chasing what worked yesterday can expose portfolios to unnecessary risk tomorrow. The real reason big investors are moving out of tech stocks right now is strategic repositioning. They are managing risk, locking in gains, and preparing for the next phase of the market cycle. It's calculated, it's data-driven, and it's disciplined. Markets constantly evolve. Capital moves where opportunity appears strongest. And the smartest investors don't wait for headlines to confirm a trend. They act before the crowd fully understands what's happening. So the question isn't whether tech is finished. The real question is, where is institutional money flowing next? And how can you position yourself intelligently within that shift? Because in investing, success isn't just about picking great companies. It's about understanding timing, cycles, and strategy, just like the professionals.